the shipping lanes are blocked. The insurance premiums for commercial freight have just quadrupled in the last 48 hours. You are staring at a monitor, and your mandate is simple. You must place an exact mathematical dollar value on the probability of a regional war expanding by Tuesday. You are a junior risk analyst at a massive maritime insurance syndicate in London. You are 23 years old. Your screen displays a map of a contested strait, dotted with hundreds of green triangles. Each triangle represents a commercial vessel carrying millions of barrels of crude oil, liquid natural gas, or grain. Your job is not to care about the politics of the conflict. Your job is to calculate the probability of those green triangles turning into total losses. You build the models. You factor in missile ranges, drone interception rates, and the proximity of naval escorts. You adjust the risk premium by 20 basis points. You send the spreadsheet up the chain. You wait. You drink cold coffee and realize something fundamental. The news anchors talk about treaties and diplomacy. They are looking at the surface. The underlying reality is that global supply chains do not stop for ideology. They stop when the cost of capital exceeds the value of the cargo. You are the one calculating that cost. Pause and consider this. What actually stops a shipment of grain from reaching a war-torn continent? It is not a blockade. It is the moment an underwriter decides the whole insurance is too expensive to underwrite. You get promoted. The title on your door says Senior Underwriter. You are no longer feeding the model. You are setting the price. The environment changes. You are taking calls from the logistics directors of massive multinational conglomerates. They want to know if they can route their fleet through a zone where live fire was exchanged yesterday. You do not offer them comfort. You offer them a percentage. You tell them that traversing the corridor will cost them 3% of the total hull value in a single transit. They complain. They argue that the naval presence has increased. You do not argue back. You know the exact mathematical tolerance of their margins. They have to ship the cargo, and you hold the only mechanism that allows them to do it legally. They accept the premium. The ships sail. You realize that your firm is not insulating the world against war. Your firm is making the continuation of commerce during a war structurally possible and highly profitable. If an ocean is perfectly safe, the premium is zero. If an ocean is completely destroyed, trade stops. The profit exists entirely in the friction between safety and destruction. A Tuesday morning in November. A notification flashes on your terminal. One of the green triangles has vanished. A bulk carrier insured by your syndicate has been struck by a loitering munition. Total loss of the vessel. Severe casualties among the crew. The news cycle erupts. The images of burning steel dominate every screen on the trading floor. You pull up your exposure model. You calculate the payout. It is $90 million. You then calculate the aggregate premiums you have collected from the 400 other vessels that made the transit safely this month. The collected premiums total $140 million. The model worked. The syndicate remains deeply profitable. You expect to feel a profound sense of tragedy for the crew. You expect to feel the moral weight of pricing human survival. Instead, you feel a cold, absolute validation of your mathematics. You feel efficiency. Your empathy has been replaced by calibration. You understand the rules of the system now, and you stop apologizing for how well you play the game. You move up. The title changes to Director of Sovereign Exposure. You are 35. You manage a team of 40 analysts. You no longer look at individual ships. You look at the macroeconomic impact of closed waterways. You sit in rooms with no windows, advising the supply chain architects of the largest retail empires on Earth. You tell them that the conflict will not end in 6 months. You tell them it will become a frozen conflict, and that they must permanently restructure their Asian manufacturing routes around the Southern Hemisphere. You do not base this on leaked military intelligence. You base it on the flow of capital. You see where the sovereign wealth funds are positioning their infrastructure investments. You understand that capital at that scale is never deployed randomly. If they are building ports thousands of miles away from the conflict zone, the conflict is permanent. Look at the architecture. The politicians promise a swift resolution. The capital markets are quietly signing 40-year leases on alternative trade routes. The capital never lies. Your network narrows. You stop speaking to old friends about what you do. You cannot explain to them that while they watch the news with anxiety, you watch it as a sequence of data inputs. Your mind is permanently upgrading its ability to detach. You fly to Geneva. You fly to Singapore. You sit across from defense contractors who are structuring multi-billion-dollar procurement deals. They need you to ensure the transit of their hardware. You do it quietly, through offshore entities that do not appear on your syndicate's public balance sheets. You use words like specialty exposure and kinetic liability. You have learned that the correct vocabulary acts as legal insulation. You are invited to a closed-door briefing with a central bank committee. They are terrified of inflation spiraling if energy prices spike due to the regional war. They ask for your assessment. You speak for 4 minutes. You outline the exact threshold of violence required to trigger a total shutdown of the strait. You give them the exact date when the insurance markets will simply refuse to cover the risk at any price. They listen. They adjust the interest rate policy of an entire nation based on the timeline you just provided. You have reached the apex. You are a partner. You are 44 years old. Your net worth is entirely decoupled from the daily friction of the economy. You control the risk parameters for trillions of dollars in global movement. When a new geopolitical crisis flares, you do not feel panic. You feel a quiet, mechanical hum of adjustment. You know exactly who to call. You dial a number that bypasses every assistant and rings directly on the desk of a foreign finance minister. You confirm a quiet arrangement regarding sovereign guarantees. You hang up. You adjust the premium. You have traded your normal human responses for absolute systemic foresight. You do not love the war. You do not hate the war. You merely price the war. You are the infrastructure that allows the machine of global capital to keep moving, regardless of the destruction happening on the ground. Somewhere, 30 floors below you, a new graduate walks into the building. They sit at a desk. They open a map dotted with green triangles. They think they are here to study geopolitical relations. They do not know they are just a new component in the machine. The machine does not stop. It never stops. It just finds new people to run the calculations.